Today I'll be sharing with you the 8 biggest lessons that I can take away from my own journey investing back in the global financial crisis. Back in 2007, I was a newbie investor, and back then every stock was really going up fast. But it all came crashing down towards the end of that year, and it continued to go down all the way to 2009. So quite easy to say, that was a hard period to invest. I did lose quite a bit of money back then. So I'd like to share with you some wisdom, and today I have 8 important lessons that hopefully you can take away from this discussion and invest a bit better. Some of the companies that I invested back then do not even exist already. So it goes to show that not many companies can withstand global financial crisis, and you'll be very surprised what things will look like 12 or 15 years down the road. So back then, I also made certain mistakes such as investing into the financial sector because it was global financial crisis, correct? And I actually invested into some of the American banks through funds, and needless to say, they underperformed massively. So if you'd like to understand what to look out for, continue watching on because I have 8 key lessons for you. Hi guys, welcome back. Without further ado, let's start with the first lesson, which is don't be too sure that it is the bottom. Now, bear markets are always like that. They drift down and then they spring up. Then it always seems like, oh, that's the end. That's the end of the bear market. There's a lot of fear of missing out because a lot of news headline mention like, this is too cheap for a stock of this quality. Then what happens next is the market continues to drift down again lower. So bear markets are like that. They really suck the soul out of each and every investor. So a couple of months back, I did mention that I started to buy into Chinese equities. And I've actually increased my holdings because I thought that could very well look like the end of the Chinese tech bear market. And back then my decision was to make 2,000 per week investments for a further 10 weeks. Now let me show you the portfolio over here. You'd see that I'm still holding on to it. And back then luckily I remembered some wisdom and not went to punt 20,000 one lump sum. I did 2,000 for 10 weeks instead. But it still couldn't reach the final bottom. And as you can see in this current P&L, it's still at a minus 19+%. Now bear markets are like that. They're all about survival. Never go all in. Be very ready to understand that there could always be a lower bottom, which is regarding the second lesson. Lesson number 2, low gets lower. Plain and simple, it is the truth. In bear markets, there are always new bad news that general market has not anticipated. Take for example, if Apple starts to show bad sales, or globally, a lot of consumers are not even spending money on buying their new MacBook or a new phone, you realize that even the best of the best brands are seeing contraction in terms of sales. Or even worse news, big countries have gone into major default in terms of government debt. I've covered that possibility in this previous video, which is a new debt storm that could be coming onto the markets and is rearing its ugly head right now in Sri Lanka. So check that video out also. In a bear market, there are too many fake outs, and if you bite at each and every one of them, it's easy to get discouraged. And speaking to here, I'd like to reinforce a few things. The first is, while it's hard to stay optimistic, it's absolutely necessary in a bear market. You also need to be extremely patient and don't measure the P&L that you have against your pay because that could put things to be a very depressive state. And if it gets lower and lower, the awful feeling will get bigger and bigger. And even if the market goes lower and lower and your P&L starts to worsen, don't hit the panic button because it doesn't mean that you're investing wrongly. Give it time because bear markets are like that, and markets at some point can become irrational. Lesson number 3, don't turn a trade into an investment. Plain and simple, let me explain what typically happens. For example, a couple that wants to do renovation and they set aside 50,000 renovation budget. And then they've seen that, in this bear market, the share price suddenly gone up a bit. Oh, DBS has sprung up 3%. It looks like an absolute bargain right now. And what does the couple do? They punt this 50,000 that was meant for renovation into DBS itself and hoping to sell it if it turns a 5-10% profit. But what happens? Low gets lower, correct? So after that spring up, DBS in this hypothetical example starts to drift lower down again. And then the couple starts to rationalize, maybe DBS is a good company. We should hold on to it. It's a long-term investment. So speaking to here, I would like to caution that because investing requires discipline. A company needs to be sold out if the fundamentals are deteriorating. And similarly for a trade, if the trade design is starting to fail, then there is a cut loss system that needs to come into place. As long as you dissociate your actions, which is if you are trading, stick to trading principles. If you're investing, stick to investment principles. And for investment wise, it definitely requires a long-term investment horizon. The 50,000 budget that is needed at the end of the year cannot be invested. Lesson number 4, don't go into margin. No, back in 2008, I exhausted all my cash because as it comes down, I keep buying, correct? In fact, when it springs up a bit, I pump in even more. So it came into a point whereby I was out of cash and I went into leverage. And I used leverage to continue to increase my position size. And when the stock market tanked, I actually received margin calls. Not just me, my mom also. So I was using every month's income to fend off margin calls for myself and my mom, which is a terrible way to build wealth. You know, these days, there are even leveraged ETFs on the market. You don't even need to go into CFDs or margin account. Leveraged ETFs, I covered something in a previous video. I've actually started a trading position in TQQQ, which is a 3x of Nasdaq. I'll leave that discussion towards the end of this tutorial. And not going to margin can help you stay a lot more emotionally detached from the trading outcome. You know what Warren Buffett has mentioned before? It is only when the tide recedes that we know who is swimming naked. So again, don't go into margin, be it forex, stocks, or even cryptos. Lesson number 5. The news and the numbers will look the worst at the very bottom. Avoid panic selling. And you know, at that point of time when you see so much negativity, it's actually feeling very logical to sell. You know, DBS for example, its earnings could drop hypothetically. And not just that, there can also be earnings compression, which means DBS right now is 12 times price earnings. In the future market climate, market might demand 8 times price earnings only. And if you couple that again with earnings dropping, you realize that that's why a stock price can dive so quickly in bear situations. Always remember this saying, money and wealth transfers from the impatient to the patient. Be very patient to wait out because bear markets don't last forever. Lesson number 6. Research and buy companies that you truly understand. Some people also say that it's important to believe in a company's mission. I'll leave that up to you. And if you think about it, Singapore banks may or may not be difficult to understand because we're all quite familiar with it. Google, on the other hand, is something that we use quite often, but it also depends on whether you understand the advertising business. Microsoft, on the other hand, we're all familiar with its products. And it also depends on whether you understand cloud computing because Azure is the number 2 cloud computing player in the world. What about for Alibaba? Alibaba has e-commerce and also cloud. And just to share a bit, Alibaba's quarterly earnings has reported that its cloud computing segment has turned profitable for the first time. So that's possibly good news for Alibaba shareholders. Coming to here, we've covered 6 points already. And if you have any questions, leave them in comments sections below. And smash on the like button because it's taken our team hours to prepare this presentation for you. Without further ado, let's move on to lesson number 7, which is when a stock tumbles down, assume firstly that the market is correct before assuming that it is wrong. Let me put an example. Snapchat, with the ticker SNAP. You realize that Snapchat's share price tumbled massively, correct? Because they missed the numbers in terms of their earnings. My suggestion to you, especially if you are a new investor, is to be very cautious against thinking that the market is wrong in selling down a company's share. Typically, the market is pricing quickly what the future holds for this particular stock. It could be a shrinking in growth. It could be a shrinking in ad revenue for Snap in particular. And if you follow this wisdom in assuming that the market could be right in selling a company share down, you avoid buying certain company stock when it tumbles, and that is often associated with avoiding catching a falling knife. Lesson number 8. Buy quality companies and best if they are outperforming the index. I used to also start my whole investment search into companies that have dropped significantly. Because when they have dropped in share price, it means that they are cheap, correct? But I've actually changed the way that I approach. And let me simplify a bit on what I go through in my thought process. This is a list of constituents for Straits Times Index. What I've boxed up are the bottom 5 performers. Previously, I used to hunt in this space. Oh, which has fallen the most? Maybe it's cheap. It can rebound. But right now, how I interpret things is these 5 have certain problems. It could be business operations or it could be market sentiment causing a price earnings contraction. My suggestion is to avoid those that are underperforming. There is a whole universe of things, and especially if it's a global recession, for example, you need companies that market is voting also to survive well. You can see it as a stamp of vote that the market is giving to that company's stock price. And since you stuck with me to the end of this tutorial, I have a bonus for you. If you're unsure on how to invest in a bear market, the simplest is to buy an index. Buy a global index. In that case, you'll always be able to sleep well because the whole world cannot become zero. A company stock can indeed tank for many years and go to zero even. But if you buy a global index and be diversified, it is only a matter of time before you recover your monies. So hopefully, I've given you some words of wisdom that can help your investment journey. As always, smash the like button. Let me invite you to some of my previous tutorials that can help new investors, and maybe there are further things that you can pick up on. With that, I'll sign off from here. Thank you for watching. I'll see you next video. Take care. Goodbye.